All right, guys, so we're going to talk about incentive stock options in this video. Now, like the stock options we've talked about previously with restricted stock units, these are a form of compensation, but they are treated differently. They're structured differently and they're treated differently, okay? They're really like in the other module when we talk about, the stock market investing, we talk about options that you can buy and sell options contracts, okay? That's how these work very similarly, okay? So incentive stock options is the company is selling you, essentially, they're giving you the option to purchase company stock at a specified price at some point in the future. And so it has a vesting schedule similar to like what we talked about with restricted stock units. It could be over 2 years or 3 or commonly 4 years is a vesting schedule. There may be 10,000 shares and you can exercise 2,500 per year for 4 years, okay? But the difference here is that you're actually buying the stock, but at that specified price, which is called the strike price, okay? So like we talked about with stock options, you have the right, let's say the stock goes up in value, whatever the strike price is, you have the right to buy the stock at that price, instead of the higher value that it's currently at. It's the exact same way. So for example, you might get the option to buy your stock at 25 cents a share, and it might actually be valued currently at $25 per share. Okay, so that's a huge discount, and they're giving you the option to purchase at a significant discount, but you are paying for it. So you'll see the strike price per share, and then when you do it, you will pay that amount of money to the company. You're buying them from the company. Okay, once you vest, right, you have the option to purchase at the given price, but you don't have to exercise that option right away. Okay, typically there's an expiration date, usually 10 years out from the grant date, from the date that the option was granted to you. But you could wait. You don't have to do it right as they vest. You could wait and do it 1 or 2 years later or a couple months later. Okay, the option is yours, but you don't have to exercise that option if you don't want to. You don't have to buy the options if you don't want to. So the strike price that we talked about is like the 25 cents per share. The fair market value, or FMV, the fair market value is $25. You get to buy it at 25 cents per share. That becomes your cost basis in the stock. That's your cost. That's what the IRS uses to calculate your cost basis, your capital investment into that stock. Based on the cost basis, that's how they judge gains and tax capital gains or losses. So again, we'll talk about capital gains in the tax module, but the strike price becomes your cost basis, okay? So when you do exercise, let's say you hit the date and you get to exercise and you paid whatever amount per share, whatever discount, and you receive the stock shares. You don't owe taxes when you exercise, okay? Unlike restricted stock units, when you exercise, it is deemed compensation and it's taxable that calendar year. It's not that case when you exercise instead of stock options because you are buying the stock, okay? It wasn't just given to you, you're actually buying it. But there is one important tax consideration to keep in mind in terms of the exercise. The difference between your exercise price, so your strike price, and the fair market value is called the bargain element. The IRS does look at that and say, hey, that is advantageous and almost seems like compensation. And so we might tax you on it. So in this example, right, our $25 fair market value stock, you bought in at 25 cents. So your bargain element is $24.75, right? It's the difference between the two. They might look at that and say, based on your tax situation, we're going to count that as income for you, okay? And that is calculated not under normal federal income tax brackets, but under a separate set of calculations called alternative minimum tax. So I'll talk again in detail about that in the tax module, but essentially, based on all your income and deductions, if you have a large enough bargain element in enough shares, then they could end up calculating your overall tax bill using alternative minimum tax calculations instead of regular federal tax. So there could be tax on that based on your bargain element and the number of shares that you exercised in that year. Definitely get help with this, okay? You need to seek a professional's help, a tax professional, to make sure and check if you have tax liability there. It has to be reported on taxes what the bargain element is. You need to track it and so forth. So again, I'll cover AMT or alternative minimum tax in the tax module, but I want to give you a heads up there because it's really, really important and unique to incentive stock options. Now, there is a such thing as qualifying dispositions. So the IRS actually gives you favorable tax treatment on incentive stock options. So instead of just taxing you as income, aside from alternative minimum tax and the bargain element, okay, we're fast forwarding. So we're talking about the long-term tax treatment of these shares. They will give you long-term capital gains rates on your bargain element if you qualify, if you meet qualifying disposition, okay? And that is that you sell the stock at least 2 years from the grant date and at least 1 year from exercise date, okay? So 2 years from the grant date, 1 year from exercise date. After that, if you sell the shares, that bargain element is going to be taxed as a long-term capital gain, which is a favorable tax rate compared to income tax rates. Again, typically it's 15%, could be 0%, but typically 15%, or if you have a lot of income, it could be 20%, but that's favorable. If qualifying disposition is not met, then the bargain element is taxed as a short-term capital gain, okay? So that difference, if you don't meet the 2 years from grant date, 1 year from exercise date, then the whole bargain element would be taxed as a short-term capital gain, which is regular income tax rates, okay? So then it's just taxed as regular income at whatever tax bracket you are in, 24%, 32%, whatever. Okay, so that's important that you understand what qualifying disposition is and how to meet qualifying disposition so you get the most preferential tax treatment. Okay, so that wraps up this conversation on incentive stock options. Okay, you have the ability to be taxed very little on this equity if you meet these certain conditions. And it's important to work with a professional on this to make sure that you get it right, okay? And to make sure you're optimizing around when you exercise options and when you don't, right? You might be able to exercise options in a certain way that you avoid alternative minimum tax completely by spreading them out or bunching them potentially in certain years. So there's strategies around that we'll talk about in the tax module, but I want to make you aware of it here. Okay, we'll continue on to employee stock purchase plan.
Knowledge turns stock options into opportunity.